check on here is the bond market. And that's because this week we've got CPI numbers coming on Wednesday.
Yep.
And then we also, of course, then have after that the Fed, and people still trying to figure out. I mean, you heard there Jennifer Lee from BMO saying a 25 basis point cut is pretty much baked in, and indeed the odds favor that at this point. But there's still a lot of questions about what's going on with inflation and over the longer term. So we got a little bit of bump in the 10-year yield.
How, that CPI print, so much focus on how it impacts the Fed's thinking. Do you see trends improve? Does progress stall? We'll be watching. All right, for more on the latest market moves, let's welcome in now Dennis DeBuscher, president at 22V Research. Dennis, it is good to see you. I thought it was interesting, Dennis, you said that there's this plausible chain of events you're telling your clients, Dennis, that could lead to a market downturn. I'm just curious, Dennis, what is that possible chain of events you see?
Yeah, thank you. So that chain of events would be a much hotter than expected CPI that would get the Fed to pause and then make it clear that the cutting cycle was uncertain at best in the future, meaning through the course of 2025. So that would be that plausible chain of events. I want to make it clear we're not calling for that, but that's what you probably need, and that would probably get you to a sustained rotation out of the recent winners. Right. So we've seen a scenario where the market has gone up, obviously post the election, led by a lot of growthier names. So if you were to see something like I just outlined, you'd probably see a pretty significant rotation out of the winners, which would take the market lower.
And so if that isn't your base case here, what do you think are the biggest sort of potential risks, either between now and the end of the year, or, let's sort of stretch it into the beginning part of 2025 also?
Yeah, so the biggest risks, unfortunately, and when I say unfortunately, they're just hard to forecast in real time, are shocks, right? So we're in a scenario now where the economy is in a durable expansion. Inflation doesn't appear to be a major problem. You should expect the expansion just to continue unless there's a shock to financial conditions. That could happen with a very unexpected Fed or inflation print that I just mentioned, or that could happen from a policy side. Maybe tariffs end up being a lot more onerous than what people are expecting. But beyond that, it's really just outside shocks, which are very difficult to position a portfolio for. You're thinking more about hedging positioning than actually positioning your portfolio of shocks that may or may not happen.
Dennis, in my inbox this morning, more notes from strategists bringing up sentiment. And their point was to their clients, Dennis, sentiment, one of those variables, it doesn't matter until it does, right? But from a short-term trading and contrarian perspective, they didn't love what they were seeing in terms of this kind of rising bullish sentiment. And I'm just curious how you're thinking about that.
I very much appreciate sentiment as far as a contrarian indicator, but to your point, you kind of need it with a catalyst with it. And that's why I mentioned that plausible scenario that could be a catalyst for a reversal in sentiment. But what are the odds that we're actually going to see a much higher CPI print? What are the odds that the Fed is going to signal much tighter financial conditions? They don't seem that high to us. So when you think about sentiment, it's just it's a little bit foolish just to assume it's going to reverse for the fun of it. Like, we're not in a game of sitting here forecasting like sentiment's overextended. I get it. That could lead to more severe than normal drawdown in risk assets. But just saying that, or positioning that for the fun of it doesn't seem like the best strategy.
Dennis, as you know, it's that treasured time of year when many of your colleagues on Wall Street come out with their 2025 end-of-year forecasts. I don't think that's part of your practice, if I'm not mistaken, but I'm curious kind of the direction you think we're going for 2025, and if you think we could potentially see double-digit gains, or that's behind us.
Yeah, so we'll have a forecast. We usually do it the first week of January once we know everybody else's. That's a nice sell-side trick. But beyond that, I would say it's essentially one of lower or more muted market returns. And I don't think we're out of consensus with that. So you should expect the market to have much more muted returns relative to the last 2 years, which, by the way, is not the most heroic thing to say in the world. Obviously, +2 plus 20-year returns. To say that we're probably not going to see that again is, again, not a heroic thing, but does get us focused on internals of the market and are the laggards of the last 2 years going to catch up? And those laggards are very clearly value and small caps. And that's the question investors are asking. Do they just keep on running with these winners, or do you position for a rotation and kind of not too focus on the overall market?
With small caps, Dennis, you noted, you expect small caps to outperform next year, but you argued it's sort of a show me story. What do you mean by that?
It's a show me earnings story. So when you think about small caps this year, They're up, but they've obviously lagged, and it's been all multiple expansion. Whereas the S&P had multiple expansion plus earnings growth. So next year, small caps earnings are expected to be up roughly 20% relative to large caps, roughly up, call it 14.5%, which is great for small caps on a relative basis. But you actually got to see that happen, right? It has not paid to front run that. And given how much multiple expansion you've already seen, you probably need to see those small cap earnings actually come through. And there are questions around margins next year. There are questions around the impact of tariffs to the extent that we get them in an onerous way or not. And so, you'll probably need to see that proven out because people have been burned on the small cap trade a number of times where it hasn't actually worked out because the earnings just were not there to backfill.
So let's talk about the other choices then, Dennis. Do you just stick with what's been working, which has largely been large cap tech? Or do you buy into the broadening narrative, just not broadening as far down as small caps, perhaps?
Yeah, I buy into the broadening narrative over time because our call is those earnings will actually come through over the course of 2025. But if we can segregate the market into the longer term, say what's going to happen over 2025 and what's going to happen over the next 3 months, being short large caps over the next 3 months doesn't seem like the best idea. Well, maybe it's never the best idea. I should have that tattooed on my forehead, don't short monopolies. But, they're great companies. The backdrop is strong from an economic point of view. Inflation is muted. Not the type of backdrop where you want to be negative on growth unless the earnings picture starts to change on a relative basis. So I think that happens. We think that happens next year, but we're not going to see anything on that front for the next 2 to 3 months. So why would they not keep on working?
All right, fair enough. Dennis, great to see you. Thank you so much. Come back and see us when you do have that 2025 forecast in January. We'll be looking for it. Appreciate it. Well, the wait is over. Apple's iOS 18.2 update is here. Joining us from more Yahoo Finance tech editor Dan Halley. How big a deal is this one, Dan? Help us out.
Yeah, so this is the second kind of batch of big AI updates that Apple's rolling out as part of Apple Intelligence. And so this one is, I would say bigger than the first. Obviously, the first was important because, well, it was the first. But these are the features that I think Apple really wanted to get out the door initially, but had to delay for one reason or another. So the main thing is you're getting ChatGPT integration. This is all part of iOS and iPad 18.2 and macOS 15.2, by the way. And so you're going to get ChatGPT integration with Siri and with writing tools. You'll be able to essentially say to Siri, hey, check this with ChatGPT, and it'll ask you if you actually want to do that. You'll confirm, and then you'll move forward. Apple says that it's not going to allow ChatGPT or OpenAI to collect your information unless you sign into your own OpenAI ChatGPT account, in which case that would all fall under ChatGPT then, and they would be able to do whatever they normally do with your information. But if you're just using it on the iPhone regularly and not signed in, you're clear. The other features include things like visual intelligence. This is something where you're going to be able to use your iPhone's camera control button to do visual lookups about items in the world around you. Say you're at a museum and you see a piece of art and you want to know who made this. You'll be able to point your iPhone at the artwork and then say, who made this? And look it up, and it'll provide you with that information right there. You'll also be able to do things like look at restaurants and get the times and ratings and things along those lines, maybe the menus, things along those lines you can imagine going forward. The catch here is it needs to have camera control, which is only available on the iPhone 16 line of iPhone. So if you don't have that, you're not getting visual intelligence. Other features include Image Playground, which allows you to make photos, say, of Juan Soto, MLB player, in a Mets uniform, which is awesome. And I'm going to get a shout out for mentioning that. Or something like Genmoji, which is a means for you to create your own emojis, or memojis as Apple refers to them, then drop them into things like text messages. So a number of updates, but really the big ones here are the ChatGPT integration and that visual intelligence. I think a lot of people are going to enjoy those. Whether or not it helps to boost iPhone sales, I mean, it really does remain to be seen whether or not any of this is going to boost iPhone sales. There's a lot of murmurs about whether or not the next generation iPhone, the iPhone 17, is going to be thinner, a different look and design. I think that's something that gets people more excited than software updates. I think people say, oh, what's this with the software update? Can I try this? It really is more of the hardware that gets people going, though, out to the store and to buy. So that'll be next year, most likely.
And Dan, switching gears here a bit, we're also seeing news about OpenAI's new video generation tool. What can you tell us about that?
Yeah, this is Sora. They debuted Sora some time ago, basically showing off its capability. It's very impressive. It generates video. Now, it's not going to generate like a 2-hour movie for you because that would take enormous resources. But couple of second clips here and there, you'll be able to generate using Sora. You can sign in and start to use that now in the US and other countries is what they're making available. This is something that we're going to continue to see more companies dive into is the video generative AI. Meta, Facebook parent Meta, showed off their own model, and there's others out there that are offering capabilities similar to this. It's basically just a progression that we're seeing. A few weeks back, Nvidia had showed off a model that's just researched, though, but shows off audio generative AI, where you can say, put together an orchestral composition based on this little tune that I hum, and it would be able to do something like that. So we're seeing more and more of this multimodal, multimedia approach to generative AI. Now, this obviously continues to raise the question of, where does the art begin and the technology end, or, vice versa? What does this mean then for camera people, for producers, things along those lines? These are all sticky questions that we're going to have to eventually come up with answers to down the line. Some movie studios are already investing in this. Some game studios are investing in this to provide them with a quick means to get content put together. So we'll just have to see where all this goes. But for now, it is interesting to see OpenAI, ChatGPT maker OpenAI releasing this.
Yeah, we'll see how it goes. Dan, thanks a lot. Appreciate it. We're just getting started here on market domination. Coming up, the Chinese government has pledged further economic stimulus, and that's got shares of some of the U.S.-listed China stocks jumping today. We'll speak to an expert on the other side about the country's latest stimulus push. Plus, shares of AMD falling on the back of a bearish analyst note. We'll check in on some of the top calls of the day later in the hour. Stick around, all that and more when market domination returns. Now time for some of today's trending tickers, sponsored by Tasty Trade. And you can scan the QR code below to check out the best, worst, and most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look at the Boeing as the company continues with layoffs, cutting hundreds of more jobs. Now, this is part of previously announced plans by the company, but we're seeing a report here that almost 400 people have been laid off at the companies in various places in Washington state here. That's according to a notice from the state's Employment Security Department. You know, when companies lay off people in many states, there are regulations that they have to post that they are doing so.
Yep, and this is part of that wider job cut. It sounds like that Boeing announced, this was back in October, Julie, which I think was expected in total to actually impact about 17,000 workers. Separately, interesting note from the analysts at Bloomberg who cover this space. They were sort of talking to their clients about airframers and, broadly deliveries and how they're likely to rise for most aircraft in 2025. They actually said, by their estimate and math, Boeing appears poised for the greatest increase. As they said, the effects of the strike fade, quality at Spirit Aerosystems improve. That stock has obviously been crushed this year. So
yes,
if you're an investor, you're hoping for better times ahead.
Down by almost 40%. Meanwhile, also just a quick note, CEO Kelly Ortberg continuing to sort of remake the team there. The top lobbyist at Boeing is going to be stepping aside, according to Bloomberg here. Again, there's been, I think, 4 executives in that top level who have left the company as of late. So we'll see what ends up happening, what the team ends up looking like, and whether it yields some results for Boeing.
All right, we will finally, let's look through another name here. Turn to shares of Comcast. CEO Dave Watson warning of losses in broadband subscribers. So you can see Comcast under some pressure there today. Company projects broadband subscriber losses more than 100,000 in the fourth quarter. Hurricanes Helene and Milton, it sounds like, causing around 10,000 broadband losses. This is from the exec speaking at this conference, Julie, talking about competition in residential broadband in Q4 remaining intense. Analysts adding that gains in average revenue per user are also going to be challenged in Q4.
Yeah, our Alexandra Canal there at the conference where the Comcast chief made these comments here. And among other things, on that last point about average revenue per user, he said it's going to be at the lower end of a range between 3% and 4% for the current quarter. And again, I said Comcast chief, Comcast cable chief, I should be precise, of that particular business. So basically, he said, when you look at the hurricane, when you look at some of the other factors, that he said, quote, we could be looking at a broadband subscriber loss in the fourth quarter of just over 100,000. That's how things remain competitively intense, but consistent with the earlier parts of the year. And again, that reporting from our Alley Canal, the stock down about 11% year to date.
Yeah, I mean, Comcast has been making moves. We've talked about that, spinning off cable properties. The company's talked about how it wants to go on offense as the industry just deals with this trend of just increased cord cutting.
Yeah. Well, China stocks are rising after the country's latest stimulus push. For more, bringing in CraneShares CIO Brendan Ahern. Brendan, we're sort of trying to understand and contextualize this announcement versus many of the other stimulus announcements that we've heard out of China. So help us do that. How are you thinking about what might be different this time or not?
Well, one is, who did this message come from? And it came from a Politburo statement release. So this is really almost like the highest echelon of the Chinese government. This would almost be like the president's White House cabinet. So the release itself was from a meeting presided over by President Xi himself. And so one is just who it came from. The second would be what was in this release that's maybe different from what we've seen in the past. One was that they used the term monetarily loose to describe monetary policy. That's the first time since 2011 that they used the term loose as opposed to stable. And then the other thing it mentioned in the release that got investors very excited is that they used the term proactive fiscal policy. So a lot of what we've seen in terms of policy support has been more geared to the housing market, local governments, the stock market, and housing. This was very, very specifically focused on domestic consumption, something that I think particularly foreign investors have been waiting for.
Um, you know, when you look at how the rhetoric thus far has sort of translated or not, I saw an interesting chart today looking at spending, federal spending there in China, and that there hasn't really been a lot of change over the past few years. Here's the chart here, and it looks at spending plans through October in green, then what happens the rest of the year, and the sort of annual forecast from the government there. And this year, we haven't seen that sort of rest of year figure yet. But the past few years, they haven't even met their own forecasts here. So I guess the question is, how much more spending are we going to actually need to see some yield in the economy?
Yeah, I think we've got the China Economic Work Conference, which is really a big economic policy meeting taking place this Thursday and Friday. That meeting, we're not going to get specific GDP targets or how big of the fiscal deficit we're apt to see. That might not come until the the dual sessions in March. But I think what you're going to see is verbiage leading us to believe that the GDP target for 2025 will be around 5%, as well as that budget deficit expanded to 4%, as well as continued policy to supporting the housing market, the stock market, as well as potentially expanding some of the subsidies we've seen applied to auto and home appliances. That expanded as well. So the key is just that the super tanker is shifting. It doesn't shift on a dime. It can't do a 180. But certainly the trajectory of policy is becoming very supportive.
And so given that, Brendan, I'm just curious, big picture, when you look at the Chinese economy versus, say, 6 months ago, is it the same, or you see signs that, no, it's picking up here?
Yeah, I think without question, you've seen things like the Citigroup China Economic Surprise Index increase pretty dramatically, really since we saw that September PBOC kind of policy bazooka released. We've also seen continued support. So again, I think it's this incremental pushing along of the economy. I think they've been hesitant to do the kind of free money, the proverbial helicopter money type kind of sugar high stimulus that they think could lead to higher inflation, greater debt, and more of a short-term boost. They're looking for more structural positives to kind of get the economy going, particularly this domestic consumption that's been quite tepid following even the release of zero COVID policy 2 years ago.
So Brendan, bottom line here, is this finally sort of the all clear signal for U.S. investors who have been waiting to see whether it's a good time to get into China?
I think that's a great question. I think ultimately the geopolitical has been the significant overhang on the space. Professional investors are very hesitant to allocate because they're afraid of like a news headline coming out. I think what's happening, what's going to force those investors back into the space is the continued performance that I think most investors would be surprised that KWEB is up almost 50% from its January low. So you're starting to see this outperformance of Chinese equities, which I think was going to put a lot of kind of pressure on professional investors who have low, no, uninvestable attitudes to Chinese equities, despite the compelling valuations as well as the policy support to get the economy going.
And switching gears a bit here, Brendan, I'm just curious, we all saw these headlines today, China opening this antitrust probe into Nvidia. To be honest, Brendan, there were some analysts who were saying, listen, they actually weren't surprised. When a company has 90% plus market share in a hot market, regulators do tend to come knocking. But I am curious what you made of that.
Well, I think we've seen similar anti-monopoly brought up against other Western companies in the past that usually leads to some sort of fine. It could be that maybe the Chinese policymakers picked up a copy of Art of the Deal and they're using a significantly widely held U.S. company that does a lot of revenue in China. More than 10% of Nvidia revenue is in China. Maybe this is one of their leveraging tactics going into what we believe will be fruitful negotiations between the U.S. and Chinese government to sort out some of the trade some of the trade deficit, some of the unfair practices maybe in China. So maybe this is a little bit of the art of the deal from the China side.
Do you think that when all is said and done, it is going to be more of a hit to U.S. companies that have a relationship in China? Or or Chinese companies that sell into the U.S.?
I think ultimately U.S. companies with high China revenue have no beta, no correlation to a lot of the media headlines. And arguably, today's one of the first times you've seen a U.S. stock with high China revenue react to that news. But I think ultimately the U.S. needs China just as much as China needs the United States. Yes, China does export a lot to the United States. But again, a lot of those are inputs that go into higher end manufacturing. It's cheap, low cost goods. A lot of those goods have create a lot of pollution to create. So there's no appetite to bring any of that back. At the same time, U.S. multinationals generate more than $500 billion worth of revenue in China annually. There is no trade deficit if you add those revenues to explicit U.S. Exports to China. So I think it's just the two sides coming together. It's very clear, as President Trump said yesterday, that he's been in contact with President Xi. So I think ultimately the two sides coming together, all of these issues can be worked out because the two sides economically do need one another.
Brennan, always great to have you on the show and appreciate that insight. Thank you.
My pleasure. Thank you.
Stick around. Much more market domination still to come.
MicroStrategy has been soaring, although not today, as the company continues to buy more Bitcoin, adding another 20,000 it revealed in a statement today. And leveraged ETFs like one from Defiance are trying to amplify the daily return of MicroStrategy even more. Joining us now, Sylvia Jablonski, CEO and CIO at Defiance ETFs. Good to see you, Sylvia. Thanks for being here.
Good to see you too. Great to be here.
So this phenomenon, not just of single stock ETFs, but leveraged single stock ETFs, is really interesting. It's especially interesting with a company like MicroStrategy, which has been such a rocket ship this year. How did you guys decide to intro this one? And what are you hearing from clients? I mean, obviously we've seen the assets grow, but kind of what reception it's gotten.
Yeah, and I actually remember the last time I saw you in person, you and I were just kind of talking about this stock, right? And how it was doing and whatnot. And so our company at that time had also been talking about this stock, and we noticed the way that MicroStrategy performed as crypto performed. And so whenever you saw over the last year and a half or so Bitcoin rise, MicroStrategy would rise 2, 3, 4, 5 times that. It just almost looked like a levered play on Bitcoin by accident, right? Not so much by accident, it turns out, as we know that now MicroStrategy's balance sheet is essentially all crypto, right? It's become this crypto treasury type of product, specifically holding Bitcoin. And so we thought to ourselves, well, the Bitcoin ETF market is quite crowded. You have the single name stocks out there. You have levered Bitcoin ETFs out there, Ether's covered, things like this. And so we thought to ourselves, like, what isn't covered when it comes to Bitcoin and crypto? And there's just such a huge appetite for this. And we kept coming back to MicroStrategy. And so we saw that, there's this huge investor appetite for that stock as a one beta, single name company. And the reason for that was because of Bitcoin. And so we levered that up and created this 2x daily MicroStrategy ETF. And, to answer your question, it's been out since late August, and the reception has just been great. Billions of dollars have flown into the product, and people are just actively and happily trading it.
You do have competition in that space, Sylvia. For example, there's the T-Rex ETF. I'm just curious, what do you think your sort of competitive advantages are here?
Yeah, I'm sorry, I've never heard of that company. Could you tell me about them? No, just kidding. Yeah, I mean, we're both taking a stab at running the 2x MicroStrategy ETF products, and we both kind of go about it in similar ways, right? We're using a combination of equity derivatives like swaps and options, and it'll kind of play out who has the best mousetrap over time. But we both have a great product for exposure. I would say that ours is doing a good job capturing that 2x beta consistently, and it's running and is managed well. And we're Defiance. I think it's part of our DNA. So of course we would position ourselves as the leader there. We were the first ones to come out with it too. So first mover advantage.
How much trouble are the managers of the ETF having in doing what it's supposed to do, right? Because there's been some reporting that the swaps contracts that are typically used for an ETF like this, that it's gotten kind of tricky because of the size of these ETFs, because of the demand. And so that, as you said, you use a sort of a combination strategy. Is it tough, though, to get that exact 2 times performance?
Yeah, so whenever you have a stock that's highly volatile and it's, or an ETF that's highly volatile and it's leveraged, it introduces some risks and some challenges and things like this. And of course, banks have their own views and their own risk departments, and they kind of dictate whether or not they would like to provide swap exposure to a particular counterparty for a particular name. And of course, single names are different than ETFs, right? You have less diversification risk on a single name. And so, banks make those decisions every day. And so we have some swap counterparties that are banks and that are interested in the swaps business. And, so does our competitor. But the options market is incredibly liquid. And what I would say is that, while the challenges of this are being reported in terms of, swap, perhaps some hesitation for new players to jump into swap, what I will say, though, is that the flexibility in ETFs has changed a lot over the last year or so, with this renaissance of options-backed ETFs and single name leverage ETFs and covered call strategies and things like this. ETF providers and issuers and options traders have figured out that there are more efficient, cost-efficient ways specifically to run ETFs, and using options and, flex options that allow you to get Delta One exposure are a great way to actually, enhance how you run the ETF and manage the strategy. And so, we have a whole toolbox of tools that we can use to get the 2x exposure on a daily basis. Is there slippage amongst levered ETFs, ours or anybody else's? Of course, there's often some sort of market event that, perhaps can get you to miss your target. But on a daily basis, they're doing pretty well in terms of capturing that 2 beta.
I guess I would ask, you've got these levered ETFs on top of what is effectively a leverage play on Bitcoin, right? Because we know that MicroStrategy is borrowing in order to just put more and more money into Bitcoin. We actually talked to Michael Saylor, the executive chairman, last week, and he just basically said he's going to keep buying it no matter how it goes. He doesn't try to time the market. He just keeps buying it. So, are there risks here, either for investors or for you guys at some point because of the volatility and because of that strategy?
Yeah, and that's a great point. And I certainly wouldn't undersell the risk, right? These are daily leverage ETF products. They're meant to be traded and not held. They're meant to be actively monitored. The typical holding period for levered and inverse ETF products is under 2 days or so. And that doesn't necessarily mean that, all of them are held for only 2 days. But I think that, these have been out for a long time, and investors now understand that what happens. So when you have trending markets, you tend to outperform your beta. They say trend is your friend, right? So over a couple of days, if the market keeps going up and up, you'll probably get more than 2x during that time period. But if the market experiences any kind of range-bound volatility, you can do a whole lot worse than the simple return of the index during that time. And so these are products that have a lot of risk. If the market's volatile, they decay and essentially you lose returns. And so the big thing is just understanding that they're daily levered and rebalanced ETFs, and you should think about your portfolio the same way when you trade them. Daily rebalanced leverage matters.
Sylvia, always great to see you and have you on the show.
Thanks for having me. Great to see you.
All right, let's get to our call of the day, and it is Advanced Micro Devices. That stock is moving lower today after the team at Bank of America downgrades that one from buy to neutral. Price target 155. Julie says downside risk to 25. Expectations that they talk about, they do lower their 2025 and 2020, looks like 26 pro forma EPS estimates. Talk about greater competitive risks in AI against best of breed Nvidia,
exactly. So that's really why they are changing this here. In the note, Arya and his colleagues say AMD's pipeline remains a year at least behind that of Nvidia, which is accelerating. Also, he points out Amazon has indicated its preference for alternative custom chips as well as Nvidia. You put that with Google, which also prefers those custom chips and Nvidia. He says Microsoft, Meta, and Oracle, yes, they like AMD, but that Nvidia's Blackwell is also taking away some of that demand. So.
Yeah, not great for AMD bulls this year. The stock is down roughly 10%. Most on the street still believers, though. There's not a single sell on this name as we head into the new year.
Interesting.
All right, private markets are grabbing investors' attention. BlackRock, one of the largest asset managers, has its sights set on the growth of private markets. But our next guest highlighting how that growth could evolve into throwing private investments into the ETF mix. Tellus Demos, heard on the street, writer and co-host of Take on the Week podcast at the Wall Street Journal, joins us now to discuss. Tellus, it's great to see you. So in this column, Tellus, you walk your readers through how BlackRock is basically betting that private markets could morph into ETFs. Now, BlackRock is kind of replicating the playbook of their acquisition of iShares, but walk us through it, Tellus.
So, we take it for granted today, but ETFs were not always the sort of mega asset class that they are now. 15 years ago, they were big, but they weren't big like they are today. And so when BlackRock made what was a transformative deal for them back in 2009, to buy the Barclays Global Investors business, which had inside of it the iShares ETF business. And that really launched them into the, kind of gigantic, supermarket of asset management they are today, managing over 11 trillion. And so similarly, you can argue that assets like, private companies, private equity, and also private credit, right? Private loans to private companies, things like that, are not small today by any means, but they also aren't, generally part of a lot of people's portfolios. And so you could say, like, that similarly, there's some sort of big transformation to come in those markets as well. And likewise, it's not just about the fact that these assets exist. It's also about how they're packaged, how they're priced, how they're sold. And that's where I think that there's an enormous opportunity for a company like BlackRock to take the various pieces of the private credit market, which sometimes gets talked about as monolithic. It's actually a lot of different things. To take those, package them up in a way that suits, various different investors' needs, whether that's a pension fund, an insurer, an individual, and deliver that to them, even without being, necessarily the actual people going out and making these loans, right? The people in the field, it can still figure a way to package that in a way that makes BlackRock a lot of money and generally grows the size of this market.
Well, it's so fascinating, Tellus, because there has been so much demand for alternative investments, and particularly private investments, but the access has been limited, right? I mean, you could buy shares in something like a Blackstone, of course, but unless you were a certain echelon of investor or a huge institution like the ones you're talking about, you didn't have access to this. And so, I mean, maybe it's a little bit surprising that it took so long, right, for somebody, and it hasn't even happened yet. We're just sort of theorizing. But looking at their acquisition of the ETF business that led to iShares, like, what can we sort of extrapolate as to what this could look like?
Well, I think that, we've started to see these things trickle into the broader market, right? Like there are, some funds that are available, not necessarily to all investors. Some of them are not publicly traded. They are available to accredited individual investors. And obviously, like you said, institutions, though, of course, sometimes those institutions are people's, kind of most investors' pathway into anything, right? So if you have a pension that's managed by someone, they might be invested in that. So it's not that we collectively haven't had exposure to these things. And then also, there are publicly traded vehicles like business development corporations, BDCs, REITs, things that own kind of these chunky private assets that you have access to. But it's been, more, I would call it like, compare it to an a la carte sort of offering, right? Like if you wanted to go out and seek these things out, you could find them. Maybe they might even be part of something an advisor would get you into, but they haven't yet become part of the mainstream of like, oh, I've got my 401k, my company allocates it to something, right? Say that's like a target date fund, like, right, some really mainstream vehicle. Those things are still almost entirely invested in just public markets in general, right? Maybe they're diversified between stocks and bonds and maybe some stock sectors, right? And that's where ETFs have really come in, where you're not necessarily an active investor, but you might want to say be a little overweight the US. You might want to be overweight a particular sector. The ETFs can help you do that. So I think that there's still, so although all these things have maybe existed for private assets available to the everyday investor, it hasn't been something that's been more, call it, sort of strategic than tactical, right? It's not just like, oh, okay, I want to add a little bit of this flavor or that flavor. And that's where I think there's a major frontier, is being able to just sort of, bring in a little bit of this exposure here, a little bit of this, of that exposure there. And that's actually an interesting thing that BlackRock did as well. Like, not only have they acquired managers of these assets, they've also acquired a data company, right? Preqin, over $3 billion deal they did for basically data to help figure out, oh, okay, here's what the return profile of this flavor of private asset is. This is why it might fit into that type of portfolio, and convince people who are now 100% in public assets to get into private assets.
Yeah, more flexibility, to your point. A really interesting point about strategic versus tactical. Tell us, thank you so much. Interesting stuff, and I guess watch this space is the takeaway. Appreciate it.
Thanks for having me.
Coming up, we're taking a look at the best ways to play the Magnificent Seven tech stocks with today's Investor Playbook. Stay tuned, more market domination still to come. Three Magnificent Seven stocks have recently hit all-time highs, and with the new administration focusing on lower taxes and deregulation soon to assume power in Washington, every investor wants to know how much more room do these stocks have left to run. Joining us now, Daniel Niles, Niles Investment Management founder and portfolio manager. Dan, it's good to see you here. With all the broadening talk, we did see tech lead gains last week, so the broadening sort of paused, if you will. But what do you think is going to happen next year? Are we going to continue to see the runs that we've been seeing?
Yeah, I think next year you're going to continue to see the broadening pattern. And if you look at it over a longer term basis, so if you look at the first half of this year, the S&P was up 14%, but that was really led by the Magnificent Seven stocks. The equal weighted S&P was up 4% during the first half of the year. Since June 30th, however, the S&P is up about 12, but the equal weighted S&P is also up about 12%. And the policies of the incoming administration, which is lower taxes, more deregulation, that should help a lot of the smaller mid-cap stocks and more stocks in the value space where the cost of money and regulation matters much more for them than a big behemoth where it really doesn't matter that much at all. And then the second part of it is I do think you're going to see a pause or a digestion phase in all this AI CapEx next year. And obviously a lot of the stocks that have powered the market this year are heavily focused on AI spend. And so if there is some slowdown in that, you could see a big issue in the tech space, and that could potentially affect the overall market as well.
You know, Dan, you mentioned Trump moving back into the White House, and what's interesting is how he thinks about big tech. I mean, last week when he announced his support for Gail Slater, Trump just went off on big tech, right? I mean, made a point of their stifling competition, they're running wild, and certainly J.D. Vance, no fan either. What they seem to be is more fans of little tech, for lack of a better way to put it. I'm just wondering, Dan, like as an investor, when you see those kind of headlines, how do you think about that? Do you think about that, or is it noise to you?
It's not noise because you always want to invest with tailwinds. And so if you know that the new administration is really more focused on helping the littler names, then that gives you a little bit of a tailwind if you go look at that. But from a bigger picture basis, Josh, I think it's more about the fact that you had a 60% increase from the biggest spenders, the Microsofts, Googles, Amazons, for AI CapEx this year, and next year you could see that number slow to 10 to 20%. And a lot of companies, especially in the semiconductor side, aren't necessarily thinking that's going to be the case. But if you're not ending up with big returns on all of that investment, and think Microsoft, right? Microsoft reported the June quarter, they guided below the street for the September quarter for revenues. Then when they reported the September quarter, Microsoft guided below the street for the December quarter in revenues. And this is despite the fact that they have a 50% economic interest in OpenAI, which arguably started this whole AI buzz, which is the launch of ChatGPT at the end of 2022. And so that's the bigger thing to worry about for big cap tech next year, is if you go through this digestion phase, much like you went through after the initial surge of spending in COVID, and then you saw what happened with a lot of these stocks in 2022, that again would argue for more broadening to some of these other smaller names that have sort of been left behind in this big AI surge for the mega cap tech names.
Dan, then what are the implications of what you're discussing for the likes of Nvidia, right? Are we going to continue to see that willingness to spend on their chips going into next year? And of course, that's not even to talk about a potential headwind of ratcheted up tensions with China. I mean, we just saw an example of that today with these reports that China is looking into antitrust concerns with the company.
It's a fantastic question. And this is the way I would think about it. And you saw this during COVID. When you don't have enough supply of chips to meet demand, all your customers come in and double and triple order. Then what happens is as soon as you can meet demand, those orders start to get canceled. And so with Nvidia, they've talked about the fact that for the next 6 months, they believe that demand is exceeding their supply or ability to make those chips. But what I would say to you is I feel strongly about this, that once they catch up, because you're not seeing these big upward revision in revenues for the likes of Microsoft, for example, but you're actually seeing downward revisions, you're going to see these companies come back by mid-year, these customers, and say, you know what, we're going to spend 20% more or 10 to 20% more on CapEx this year than the 60% increase we saw in 2024. And Nvidia, if you look at their revenue forecast by Wall Street, Nvidia doesn't put out forecasts a year out in advance, but Wall Street has Nvidia's revenues up 50% in 2025, falling over 100% increase this year and the year before. And so I find it, at least from what I'm seeing today, hard to believe that they're going to be able to get to those forecasts. So you may see a nice move up in the stock in the beginning of this year, and then a big fall off in the middle of the year. And by the way, don't forget, during COVID, revenues went from up 84% year over year at the beginning of 2021 to down 20% by the end of 2022, and the stock went down over 60% in that move from peak to trough. And so that's an example of what carnage you could see going forward.
Dan, always great to see you and have you on the show. Thanks so much for joining us. Appreciate it.
My pleasure.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Let's take a check on where the major averages ended the session here. We have selling for all three here. The Dow off by 238 points, about 0.5%. The S&P 500 down 0.6%, and the Nasdaq about the same, but a little bit of acceleration of selling into the close, particularly for the Dow and the S&P here. And then you also have selling that spreads beyond to the equal weight index off about 0.5%, and the Russell as well. So not really any kind of refuge area today in terms of, all the people talking up small caps recently, not seeing that follow through today and not seeing that broadening today either. If you look at the groups on the move in the S&P 500, there's also not a lot of places of refuge. Even the groups that are up, healthcare and real estate, are up not much. Materials flat. And you've got communication services, financials, utilities, industrials down the most today. It's kind of a mixed bag of what is dragging things down. We were talking earlier about some of the big Nasdaq movers today. Nvidia down about 2.5% after reports that the Chinese government is looking into sort of antitrust complaints and related to perhaps its acquisition of a company called Mellanox several years ago. Meta shares down 1.6%. Apple shares on the flip side, I believe, closed at a record today, if I'm not mistaken. So still seeing some strength there, sort of more of a mixed picture underneath the surface of the selling that we saw in the market today. And got to come back to the China ADRs today because of the pretty broad strength we did see there after China hinted at some new stimulus to come. We talked with Brendan Ahern of Crane Shares a little bit earlier about that, and he seems relatively optimistic going into 2025. So seeing a lot of buying in that particular area, but not many of those today. Josh?
Thank you, Julie. Well, stocks taking a breather to start the week as Nvidia weighs on the broader market. The next key event for markets, Wednesday's CPI report. Now, our next guest says that number could dictate the Fed's next move. Joining us now is Julia Herman, New York Life Investments Global Market Strategist. Julia, good to see you.
Thank you for having me.
So let's start with that key inflation data. We got the CPI print. What are you expecting to see there, Julia? And how important is that for the market?
Well, I think it's normal to see this level of market jitters, especially before such a big data print, the last inflation data that we get before the Fed's last meeting of the year. It also makes a lot of sense in the context of a very resilient economy, but one that has been gradually decelerating toward trend growth. Now, you can read both the weaknesses and the strengths in the data, no matter which way you want to slice and dice it. But overall, we're seeing a gradually decelerating economy and a spectrum of data that tells us that overall, we need to be concerned not necessarily about an imminent economic slowdown, but more of a calibration of Fed policy over the next year.
And so what do we think that calibration is going to look like, right? Or, is it just too difficult to predict right now, given that we don't know what kind of data we're going to get and whether indeed inflation is going to continue to slow down?
Well, the fact that market expectations have now coalesced around a 25 basis point cut for December doesn't take away from the fact that we've seen a sharp, hawkish backup in rates for easing expectations next year to the tune of 100 basis points. It tells us that, of course, there's a reaction to the new administration, that the economy is stronger than expected, and that it is too early to declare victory on inflation. I think Chair Powell has been incredibly forthcoming that both the economy and inflation have been stronger than he initially expected. And it means that they've been preserving, I think, some wiggle room for the policy path in the next year.
But Julia, more broadly, do you feel like it's still like economy's growing, earnings growing, it's still a risk-on environment as we head into 2025?
It's quite clear that it is. And frankly, when we're faced with rich valuations, we have to sometimes look a little beyond them. One thing that my team and I are very focused right now are earnings quality. Perhaps a surprising area of earnings quality we're seeing in the market is in the Magnificent Seven, where, yes, we've seen a pretty fantastic re-rating of those valuations, but it pales in comparison to the spectacular earnings growth that we've seen there. So it's, again, just a call for investors to look past initial valuations, given that when the Fed is cutting, I think we'll be hard-pressed to find a clear-cut value argument anywhere.
Well, I guess the question is, will the quality of those earnings continue, right, going into 2025? So where are you seeing those quality pockets where you are optimistic about the pace of earnings growth going into next year?
Certainly. And I think it's the same story in the economy broadly, right, where we see a lot of strength, a gradual deceleration towards something that's a little bit more sustainable on both the economic front and the earnings front. Now, when it comes to the sort of risk-on market environment that perhaps the new administration has contributed to, we are less bullish on things like small caps. We see this as a risk-on reflection of the market market, whereas it is not necessarily the hub of earnings quality that we'd want to see right now. We need to consider cyclical factors, like the fact that historically, small caps are best bought when we are looking at a really strong economic upswing. And in my team's view, we're looking at a gradual deceleration. So not necessarily the best time to step in there.
So Julie, we talked about the economy, we talked about the Fed, monetary policy, but you mentioned the new administration too. And there's different cross currents there. We're going to have tax cuts, deregulation, tariffs. When your clients ask you as a strategist how you're thinking through it, what do you tell them?
We have essentially traded in election uncertainty for policy uncertainty, and we've seen that play out strongly in the markets. Of course, we're very focused on debt sustainability, anything that might affect that, as well as trade policy and tariffs. If I can leave you with one thing on tariffs, it is that it is too early to try to game theory out the end result of tariffs or their inflationary impact. And that's because there are two partners at that negotiating table, right? We saw, for example, China the other week implemented export bans of key raw materials that we use in our tech supply chain. And I think that paired with the Nvidia news today is a signal that we have broader economic and geopolitical relationships that are going to be at play in the trade negotiations.
What about some of the other policies, though, that the market seems to already be pricing in? Things like not just an extension of tax cuts, but maybe even deeper tax cuts. Things like, a decrease in certain regulations. Do you think that there is too much of an assumption of what is going to happen under this next administration?
Well, certainly we won't know until we have real policy change on the table, right? And ultimately, I think we need to focus on the net result for things like debt sustainability. There are so many ways that we can measure the fact that that's become more urgent. We now spend more on interest payments than we do on defense. We are accumulating about $1 trillion in federal debt every 100 days or so. And frankly, we've already seen a willingness, particularly of the bond market, to step in and signal when risks are perceived to be rising. We see that in a 10-year rising term premium for the 10-year specifically.
It's so interesting because you talk about those fiscal challenges, and we talk about that all the time, but it doesn't seem like anybody on either side of the political aisle is actually willing to really get into it and tackle what we know is the big issue, which is the big spending on entitlements. So we just, as investors, do we just continue having the same conversation?
I don't know if it's still the same conversation, but I think that we need to consider how we reflect all of it in portfolios, right? We have seen, for example, an incredible amount of volatility in inflation expectations, yield curve expectations, and the yield curve is normalizing perhaps more noisily than we might have initially expected. It tells me certain things. For example, my preferred spot to add duration is not in the Treasury curve right now. It's in the municipal bond curve, which has been more consistently upward sloping than the Treasury curve.
Interesting. Thank you so much.
Thank you for having me,
Julia. We got to get to some earnings now. Oracle's second quarter numbers hitting the wire and disappointing, as you can see from that quick 9% drop in the stock. In particular, second quarter revenue coming out at $14.06 billion. That's below the $14.12 billion that analysts had been anticipating here. When you look also at cloud infrastructure revenue, which really has been the area of the business that has been growing, that is coming in pretty much right in line with estimates at $2.4 billion. Cloud application revenue at $3.5 billion, slightly shy of estimates. And so all of that contributing to the declines that we're seeing. I mean, really, overall, the numbers, you could call them roughly in line to slightly short. But considering the run that this stock has been on, slightly short or even meeting,
yeah, I mean, it's been
ain't gonna cut it.
One of those names we talked about, Julie. It's a monster this year. It's about 80% this year heading into this print. It actually hit a record high this morning in today's trade. I'm just looking at some comments from the execs. Oracle CEO Safra Catz. Now, they're sending a very positive, confident tone, as they often do. Safra Catz saying record level AI demand drove Oracle cloud infrastructure revenue up 52% in Q2, she says, a much higher growth rate than any of our hyperscale cloud infrastructure competitors. Oracle Chairman, CTO Larry Ellison, we know Mr. Ellison never short of words here, loves to go after the competition, says Oracle Cloud Infrastructure trains several of the world's most important generative AI models because he says we are faster, Julie, and less expensive than other clouds. And that's sort of been one theme as we talked about. We talked a long time about the war, the cloud war between Amazon and Microsoft and Google, and the sense was that Oracle had sort of muscled in there, which in part, of course, helps explain the rise in the stock we saw this year, but giving up some here in the after hours.
Did you see the stat today that the stock is on track for its best performance since 1999?
I believe it.
As Oracle has sort of come back into vogue, and finally its cloud business has really caught on here. But that, again, I don't know if that 99 stat's in jeopardy, but seeing a drop like this in the shares, of course, it's always possible they could talk on the call and then you could see a reversal in the shares. So we'll stay tuned to see what those execs have to say on the call and if that changes anything.
All right, C3 AI also delivering second quarter results after the closing bell. Here to break down the numbers, Yahoo Finance's very own Akiko Fujita. Akiko.
Hey there, Josh. Yeah, investors certainly liking what they're seeing. You can see that big pop happening in after hours on the back of these latest results. The stock obviously hitting a 52-week high in the session and now rising even further. A number of beats here to report. Adjusted EPS coming in at a loss of 6 cents a share. The street was expecting a loss of 16 cents a share. Revenue coming in at $94.3 million versus the $91 million the street was expecting. The big pop, though, the stock is seeing right now coming on the back of the company raising its guidance for fiscal 2025, specifically for Q3 revenue. The company now expecting 95.5 to 100.5 million. The expectation here was at 97.5 million. There's going to be a number of things here to parse through, specifically with C3 AI. They compete on a number of AI verticals, with the biggest competitor out there being names like Palantir, who've seen a significant bump, at least in their revenue. So a lot of investors' questions going into that as well. But this is a stock that is up more than 40% year to date, and they are riding some momentum coming on the back of the expansion of their partnership with Microsoft, which they most recently announced last month, guys.
Akiko, thank you very much. Appreciate it. We want to bring you the latest developments in the killing of Brian Thompson, the CEO of United Healthcare. That's the insurance arm of United Health Group. Police arresting 26-year-old Luigi Mangione with a gun that is, quote, consistent with the weapon used in last week's shooting. New York Police Commissioner Jessica Tisch saying in a news conference that the suspect had a handwritten document with him that, quote, speaks to both his motivation and mindset. He also had fake IDs, a firearm, and a device to muffle gunshots. Right now, Mangione is facing gun-related charges, and police say the gun is likely a ghost gun that may have been made on a 3D printer. Mangione was arrested in Altoona, Pennsylvania, where someone called in a tip after he was spotted at a local McDonald's. We'll bring you more developments when we have them. In the meantime, stick around. Much more market domination overtime still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oracle shares are sliding as the company misses revenue estimates for the second quarter. Here with more, Alex Zukin, Wolfe Research Managing Director and Head of Software Research. And Alex, I say missing, but like missing by a hair here. I characterized most of the numbers here as roughly in line to slightly short, but it feels like people's expectations were riding pretty high. Is that fair to say?
Yeah, I would say at first glance, the only number that looked a little bit probably lower than where some people were thinking about was RPO. That's a testament basically to what kind of bookings the company is signing. That number went down sequentially. That's the first kind of downtick in that metric, which is a forward-looking indicator in many, many quarters. Now, what I will say is that number had been going up pretty unbelievably, would be the only construct that I could tell you, over the last, 6 quarters. I'm just looking at my model here. I don't remember, I haven't seen that number go down, but at the same time, that number ticked up by $30 billion between Q2 of last year and Q4 of last year. So the uptick was pretty seismic. The number that we were really paying attention to was IaaS, or OCI, Oracle Cloud Infrastructure as a Service. That number, 52%, very solid. The deal with Meta, also another indicator of seeing great partnering opportunities for Oracle. They've done deals now with Microsoft. They've done deals with Google, with AWS, with Meta. So they're kind of locking in, a lot of that AI mind share. So net, it's going to come down. I think the stock reaction is more indicative of how people are positioned. There was a lot of people that are long Oracle, and so we'll see kind of what the guidance entails.
To your point, Alex, listen, heading into this print, stock was just red hot, right? Up 80% year to date. I'm curious, Alex, do you now consider Oracle to be the fourth hyperscaler? Obviously it's been Amazon, Microsoft, Google. Do you think, in your opinion, have Larry Ellison and Safra Catz, have they now successfully muscled their way in there?
I would say for new workloads, for AI specifically, I think it's hard to make the case that they're not. I think they're right up there making some of the smartest deals with Nvidia, with, Larry's great friends with Elon. I think there's concepts around how well positioned they are with the new administration, how well connected they are globally with companies that are looking to make transitions to the cloud for the first time and maybe deploy AI in a not necessarily all cloud modality and looking to be hybrid. So I think they're really well positioned, and they've got the chips, they've got the right architecture, they've got experience in commercial engagements, they got a really wide breadth of products and solutions that they can bring together. And they're showing the street that growth can continue to accelerate.
So do they have to do anything differently, Alex, or do they just sort of keep on the same trajectory here as we get into the new year? Because, if they keep putting up numbers like this, either the street's going to have to adjust or they're going to have to push it a little more, maybe.
Well, look, I think they had an analyst day and they gave targets all the way up to fiscal 29. I think that, they're now talking about double-digit CAGR in the teens for earnings going all the way out there. I think over the next couple of quarters, there's the potential for accelerating growth. There's the potential for better infrastructure and OCI growth as well. I think having a 5 on the IaaS number is a big deal. Honestly, that's something where before you were getting great bookings, but maybe not as great revenue growth on that key line item. And so the fact that we got the inverse of that, I actually view as a positive. So I do think that they just have to keep doing what they're doing, and the stock will continue to work.
Call is coming up, Alex. You would expect Larry and Safra to be on it. What would you, if you have the opportunity, what would you ask them?
Well, I think the big question is, when do some of these use cases in generative AI for the enterprise that are driving the kind of demand for GPUs that we're hearing about, that we're seeing, where are they in terms of timeline to scale, timeline to revenue recognition, and the gains that are repeatable, that I think a lot of us want to see? When's that handoff from training to inference? I think is a question that I would not be surprised to see them talk through and talk about, particularly as you're hearing the approach, the scaling law question, whether we've hit a scaling wall. I think more so than ever, that handoff of training to inference is very, very important to understand, because it gives confidence the durability of the growth rates that the company is talking about.
What about, Alex, the company's legacy software licensing business? What do you see ahead for that business?
Well, the opportunity is this portfolio approach, and you've seen it play out for Microsoft. When you start having this exciting opportunity with AI, it could catalyze a conversion cycle where you really start to be able to leverage some of that functionality, leverage some of that product velocity only if you actually migrate to the cloud version of their products. They have that on the infrastructure side with the Oracle database, and they have that in the application portfolio with products like Fusion for the ERP portfolio. So I think that there's a catalyst opportunity for them to unlock and modernize and monetize their existing customer base as they make that jump, not just to cloud, but to an AI-first product functionality.
Alex, always great to see you and have that instant reaction and insight. Appreciate it.
Thank you guys for having me.
Time now for What to Watch, sponsored by Tasty Trade, Tuesday, December 10th. First up, the National Federation of Independent Businesses Optimism Index, which gives a read on how small business owners view the economy. October's reading, remember, came in at 93.7, the highest since July. Before July, the last time the index hit such heights was February 2022, when it came in at 95.7. We're also going to get some earnings important to gamers. First up, GameStop, the original meme stock, will report Q3 financials after the bell Tuesday. Analysts expecting revenue to decline nearly 18% year over year to $887.7 million, with an adjusted loss of 3 cents per share. Dave & Buster's will also be reporting earnings Tuesday, with the street expecting an adjusted loss of 41 cents per share and revenue totaling $463.6 million. The company has missed revenue estimates in 6 of the last 8 quarters.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here are some of the trends we're going to be diving into. Nvidia weighing on the broader markets as a result of a monopoly probe out of China. The S&P 500 and Nasdaq seeing their worst days in nearly a month. We're going to take a closer look at the takeaways of the trading day that's coming up straight ahead. Plus a big day for Apple, the stock closing at a new high as the company rolls out a new software update, which will include an improved Siri thanks to ChatGPT. We're going to take a look at Apple's AI future coming up. And it's the countdown to Christmas, and we're looking at where the consumer is spending their money, stores or experiences. We've got new data tracking foot traffic that is straight ahead. Well, Christmas is now less than 3 weeks away, with shoppers hitting stores looking for the best possible deal and groups heading out to eat to celebrate the holidays. Join me now to break down the state of the consumer and how this holiday shopping season stacks up to years past is RJ Hottovy, Placer AI Head of Analytical Research. RJ, great to see you on set.
Yeah, thank you, Josh. Thanks for having me.
So let's start with dining trends. And this is a space you know very well. You've spent a lot of time thinking about it, researching it, RJ. We know Americans are going out to eat. Where are they going out to, RJ? Are there differences between, let's say, this year and last year?
It's been an interesting year in the restaurant space, and I think you ask most operators, they'll say it's been a challenging year. You've got higher wage costs, you've got higher food costs, rent rates are up, you've got a consumer that's being a lot more discreet about where they spend, a lot more competition with grocers. So you've got a lot of factors working against them, but at the same time, we've got these standouts. You've got in the fast casual space, you've got Chipotle, you've got Sweetgreen and Cava, who are just really doing a fantastic job on visitation trends. In casual dining, I mean, I think Chili's has been the breakout story in the restaurant space this year. Some really big numbers there. Texas Roadhouse, a lot of it being in the right markets, but also very consistent experience. So you've got a lot of these stories, these restaurant chains that are still outperforming and really connecting with the consumer. And so I think that's kind of the lesson from 2024 is it's a tough environment, but those that are innovating, that those are giving the most value, they are driving traffic right now.
So if it's about value and innovation and experience, are there certain names you think that are better positioned to leverage that environment than others?
Yeah, I think it's a little bit different for each name here too. I think if you're looking for innovation, I think that's where the fast casual names have stood out. A simple thing like adding a new protein, so steak for Sweetgreen and Cava, some of the proteins we've seen, smoked brisket, chicken al pastor for Chipotle. These are really effective tools, and we had shied away from the restaurant industry had really shied away from innovation during the pandemic, and by necessity, we needed to pull back, simplify things to make things work from an operations standpoint. But now is the time to be innovating because consumers really respond to that. Otherwise, they may just take their dollars and go to Aldi or another value grocery store. So it really is making it stand out, whether that's new proteins or effective promotions. A SpongeBob promotion for Wendy's was one of the biggest LTOs that we saw this year. So I think those are the things that consumers are connecting with. At the same time, value is important too. Can't forget about that. But those who balance both of those are the ones who are winning right now in the category.
Are consumers loyal to certain restaurants, certain chains, or no, it's just like, give me the value, give me the best experience?
Yeah, I think there is some loyalty if you continue to deliver on that, but that's tough to maintain that experience, and I think that's a lot of what we've seen with Starbucks, and Brian Nichols talked about this too, is we need to keep that experience, make it more consistent from location to location, but those that do it, I think, are going to be interesting, and that really does set up the story for 2025. What are the names that can drive that repeat visitation trend? Right now, people are just going where they can get the best deal.
So is that, RJ, is that about, okay, I need to have, it's about innovation, I need to have the best loyalty program? What actually?
Yeah, I think there is something about you have to have a loyalty program. I think you have to have a reputation for innovation. I think you have to have just even the idea that you can get people through the line quicker too. I think that throughput and staffing has been a big issue, and just getting people to the line. I mean, that's a big thing for Chipotle. They can get people through much faster, or at least, and they're improving that metric, but they can get people through quicker than a lot of the other ones. Cava's done a really good job on this. Brett Schulman's had a great team put together to really drive throughput, particularly peak hours. I think that's an important part too. So loyalty is part of it. I think we're going to see more one-to-one marketing for these restaurants to really kind of drive excitement. But then the operation part has to be there. It's a bit of both there too. You can't just do it with the loyalty program. You have to with product. You have to have it with the experience. So it's a kind of combination of all those things.
And RJ, also another big theme we're going to be looking for, of course, Trump is moving back into the White House. There's this bet that means a friendly regulatory backdrop. Do you see the potential of greater M&A in this space in 2025? And,
and
if so, let me ask you, would there be names that look at potential targets?
I think we're going to see a lot more M&A activity in the year to come. I mean, there's deals waiting to happen. There's groups that are definitely looking at either new brands, or if you're a franchisor, consolidating franchisees. Franchisees have a tough time of it. You know, you're a small business owner and maybe you're looking to cash out. So I think we are going to see some franchisee movement, but don't be surprised if we see another brand acquired. You know, we saw Darden with Chewy's and you know, groups like that. I could see more activity happening, particularly in the casual dining space where we've seen a lot of bankruptcies. Maybe there's an opportunity to pick up a brand on the cheap. So I think that's probably where we're going to see a lot of activity this year.
And finally, so we talked dining, let's talk retail as well, because we had Black Friday, we had Cyber Monday. What did you learn from what you saw there, RJ?
Yeah, the most interesting takeaway for us was that malls themselves outperformed the retailers. So people were going out on Black Friday, but for the experience. They were going out for the seasonal attractions. They were going for pictures with Santa. They were going out dining. We saw really big fine dining numbers for Black Friday. So it's interesting because now we've had a couple of years where malls have repositioned themselves through mixed use strategies. They're bringing in more attractions, and you know the way people interact with malls has completely changed. I think we really saw the fruits of that labor come out on Black Friday. You know, certainly Moana 2 and movies helped out quite a bit too, but it's really interesting to see that people are using this as more of a destination as opposed to just a shopping trip these days.
RJ, always good to see you and have you
Josh.
on set. Appreciate it. Well, the S&P 500 and Nasdaq pulled back from records as Nvidia weighs on the broader market. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Hey Josh, yeah, the worst day for the S&P 500 and the Nasdaq Composite in about 3 weeks, but I want to start with China stocks. We had a big rally here, Josh. So leaders out of Beijing coming in and saying that they expect more accommodative monetary policy to come in, also some support on the fiscal side, and we saw China stocks take off again. This has been a trend that we've seen sort of throughout the back half of 2024 here, and really what I want to highlight here, Josh, was the takeaway from one of the articles that was on our website today from my colleague Alexandra Canal, one of our markets reporters, talking about perhaps the volatility that we're seeing in China stocks. Strategists don't think that's over. So the announcements we're getting, yes, should be pro overall business in China. But here's what we're looking at, some of the bigger names in sort of the China stock space, right? So I singled out Alibaba, JD.com, looking at KWeb. Remember, this was the September, let me get our pen on. This was the September pump that we had after all that stimulus we were talking about, September and October. We retraced most of those levels over the last month. Today, you're starting to get a bump back up, but I think there's just still a large looming question here of, it's a lot of up and down with these stocks. Is there ever going to be consistency where I actually want to stay in and own them over a long-term period? And that seems a little bit uncertain right now.
Yeah, we did have a guru on China today on the show. It was interesting to get his take. And basically his point was, Joshua, he does see, I asked him, listen, we were 6 months ago, where's the broader economy like over there? And he did argue, listen, you see signs of it picking up. And he talked about how the Chinese leadership and authorities over there, they're not looking for kind of helicopter money. They're not looking for short bursts. They're trying to really create like more fundamental change.
And you're seeing people bet on it in the market, right? A lot of stocks that are exposed to the consumer in China, right? When you think about an Alibaba, maybe a Pinduoduo, certainly catching a bid today. And I just think overall, it's a story that we're probably going to be talking about into 25 as far as how it plays out. Another story out of China today, though, Josh. So them opening an antitrust lawsuit against Nvidia, right? Looking into antitrust use for Nvidia in China. Nvidia stock taking a hit on that. And part of what I thought was interesting here was just thinking about the rally that we've had in the stock market over the last 2 weeks, sort of how Nvidia has been driving that, right? So Nvidia down almost 3% on that today. You zoom out over 10 days, over a month. Nvidia stock at some point had been doing well. It's not quite showing like I had thought. Because I didn't click it, Josh. That's why.
There we go.
So there you go. Nvidia stock had been rallying with the Mag 7. So to see Nvidia stock take a breather as the index takes a breather wasn't necessarily shocking to me, but I guess just a reminder, when semis start to fall on a day and tech starts to lag, it's tough for the market to sort of work through that, right?
Yeah, Nvidia was interesting. I did see some analysts say, at least some of them weren't surprised by the move in China. Their point was when you have just the kind of dominant market share Nvidia does, they wouldn't be surprised when regulators, come knocking, asking questions. And some of them even expected, listen, you could see other regulators in other regions having questions about that data center GPU market.
They dominate a lot of the market, right? So for someone to make a case that it's anti-competitive, you can certainly see how they get to that. But a lot of those headlines that have come out from China on Nvidia over the last year or so, 1 day pullbacks, 2 day pullbacks.
180% this year.
And then the stock finds a way to move higher, right? Final thing we're looking at, we're already talking about CPI, right? So this is the big macro event for the week, the inflation report coming out on Wednesday. And Bank of America had some interesting research on sort of what's what's been surprising Wall Street, what's been driving the market. So what we're looking at here is inflation surprises versus growth surprises. And what sticks out is our white line here through the summer. Remember what the narrative was in the summer, Josh? There was a lot of concern about, oh, the US economy is slowing more than we thought. That was kind of driving market action, right? Then as we came out of that, US economy is doing better. That's been driving market action. Well, now look at what's happening in blue. Inflation surprises are starting to become a story again. Inflation is actually not falling as much as economists maybe thought it would to end 2024. So that sets us up into a print on Wednesday where inflation's usually a pretty clean read anyway, right? If inflation's lower, it's usually good. If it's higher, it's bad. But it's starting to become more and more of the story right now in markets. Feels like we're moving from discussing growth and discussing the labor market to a little bit more of a laser focus on inflation again.
Is the expectation from economists, Josh, for this print, is it okay, trends keep improving? Is it progress stalls?
It's a little bit more of progress stalls or progress continues to stall, right? Remember after that PCE report, another inflation measure we were talking about the week before Thanksgiving, the narrative was largely inflation's going sideways. It doesn't seem like this print is going to do too much to change that. And I think the question isn't necessarily what it means for the Fed in December. What is Jerome Powell going to say next week about what that means for the Fed in 2025? Are they worried inflation is starting to plateau? Is probably going to be a key question.
All right, we'll be watching. Joshua, thank you. Stick around. Much more asking for a trend still to come. Apple launching its iOS 18.2 update today. How will that impact trends in iPhone demand and sales. For more, we're going to bring in now Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, it is always good to have you on the show. So let's talk about Apple's latest software update. Ben, this does feel like a more meaningful one, right? This idea you're going to bring now ChatGPT to the iPhone. Walk us through this, what this means for the user, Ben. How important is it, and how much is it going to actually improve the user experience?
Yeah, and I think it's far beyond, right, just ChatGPT. I think there's a lot of Apple proprietary experiences in Apple Intelligence, things that they hope make things more useful to people. And really, I think when you look at their communicated strategy, as well as many of the features that they're showing in social media and some advertisements, it's really about just functionality, right? I mean, I think people starting to use basic things, right, in email, summarize, rewrite, proofread. These are basic functions that to some degree are more meaningful than just a UI update, right, to some software. So I think the hope is really on the promise of the upside of helping people do more with these products. We're still waiting on future updates to come with a more advanced Siri and some more sophisticated features. But really, at the end of the day, this is something Apple wants to include in operating systems going forward. They're going to design hardware around these features, and I think they just continue to hope that it helps people use these devices more to their fullest and have the best experience using them.
And Ben, though, when people hear these headlines and they watch these interviews and they hear about ChatGPT is coming to the iPhone, is that the kind of news, is that the kind of feature, Ben, that you think perhaps motivates folks to upgrade?
I mean, I wouldn't say just on ChatGPT. I think the reason that brand gets pushed a lot is just simply because there's a lot of people using it regularly, right? So your normal kind of consumers who are exposed to that brand, who might use it, who might even pay for it, they'll view that as a great feature upgrade because they're already familiar with the brand and using ChatGPT to some degree. But whether that's the gateway or email's the gateway or Genmoji's the gateway, like the reality is they just want you to start somewhere and then expand from there, because for a lot of this is really a brand new type of experience, right? Using AI integrated on our devices is not something that's been normal, to humans using technology for a long period of time. And the reality is now that it's front and center, they want to keep deepening their experience with those features and hope that people really like them. And again, it just makes iOS and Apple's ecosystem more sticky. That's I think the end goal.
When we last spoke, Ben, I feel like and I asked you about this iPhone upgrade cycle. You didn't think it was going to be that dramatic, that explosive. Is that still true, or am I misremembering?
No, you're right. I think this super cycle term gets thrown around. I mean, I'm just still of the strong conviction that hardware changes, design changes drive those super cycles, not software. I do still think this is going to be a stronger than normal upgrade cycle, only because we've known that this is an aging base, something that you and I have talked about a lot. We know that there's a good percentage of people of the iPhone base that are just due for a solid upgrade. I think people with an iPhone 12 or later are starting to see some of the slowness of those devices because they are aged, and I think that's going to help drive a good portion of that aged base to upgrade, which is a significant number than years past. But I don't think we're going to see this quote unquote stronger cycle because of Apple Intelligence. I think it helps, but I don't think it's because of that. I think there's just a lot of people who need to upgrade, and that alone is going to lead to a great year for iPhone.
Going back to ChatGPT, Ben, just for a sec, there are all these reports out there that Apple actually isn't paying OpenAI for this partnership. So what is Sam Altman and OpenAI actually getting out of this?
Yeah, I mean, I think, right, this comes back to the early advantage or the early mover type of strategy. I think OpenAI, again, they're not Google. Like, in no way, shape, or form are they brand recognized or used as much as Google. So you could see how the differences of this deal between a Google for search and ChatGPT and OpenAI for other features, when OpenAI just wants to become the default. They want ChatGPT to be the default generative AI tool that people use to search information and help them go about their day-to-day. And so it behooves them to get as many people as possible committed, addicted, dependent on ChatGPT. And I think they want to use this integration with iPhone as a mechanism to do that.
And so looking ahead, Ben, I'm just curious, do you think it's going to be just OpenAI, or no, you think Apple partners with other models as well?
Yeah, I think at some point in time, Apple's wise to partner with others and give model of choice. I think ChatGPT is going to remain the dominant default position today. Every bit of research we see continues to show that that is the most used service by everyday consumers. But there's a lot of competition, and I think it'd be wise to make sure that Apple supports whatever vendor they want. Now, they might not have the same level of integration as ChatGPT. I think that's a question. But the idea that sort of like you can still actually pick your search engine on iPhone, that you might be able to pick your generative AI partner, whatever works best for you, I would imagine that will come to iOS at some point in time.
Ben, we're always lucky to have you on the show. Thank you for joining us.
Good to see you again. Thanks for having me.
Now, in the latest episode of the Yahoo Finance podcast, Money Glow Up, host Tiffany Aliche speaks to Michelle Lirish, head of advice and planning for wealth and investment management at Wells Fargo, who offers insight for managing financial stress, budgeting, and why people so often find themselves financially strapped during the holidays. You can scan the QR code below to check out the latest episodes, and be sure to tune into Money Glow Up. That's every Thursday at noon. And here's a look at the latest episode.
So when you think about holiday and stress, I do want to normalize it again, Tiffany. So it is normal. The easiest way, though, to tackle it is to talk to other people.
Okay.
And talk to other people you trust and come up with ideas together.
Okay.
So I just want to highlight that accountability partner, that conversation, being open and honest. In the United States, we have done so many studies. It's just so hard for people to talk about money and finances and financial stress. It's really not great for anyone in the U.S. So let's open the conversation like you're doing, and that's why I admire you so much, Tiffany.
Thank you.
For our chart of the day, we're looking at government spending in China as Beijing signals stimulus next year. And Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Yeah, we've been talking about this stimulus all day. We saw how it affected Chinese stocks listed here in the U.S. Basically, the change in tone and in language is what investors are pointing to here. The Politburo in China said that it is going to adopt a, quote, moderately loose monetary policy next year. And that's a big change in language for them. That's the first time they've used words like that going back to 2008. So that's why we are seeing this big lift. There are still some skeptics, however. One of them is Bob Elliott over at Unlimited Funds, and he is the one who tweeted out this chart here where he pointed out that the spending has not followed the rhetoric when it comes to what we've seen in China. So this is government spending in China. In other words, the implementation of fiscal policy, how it feeds through into the economy. It comes through government spending here. And so this is the annual spending budget forecast that we've seen, this sort of amber line. This is what we've seen in terms of spending through October, green, and then the rest of the year in blue. So we don't know yet what the end of 2024 is going to be like. But what we have seen is over the past few years, spending has not even met that projected forecast. So that's sort of the skeptical camp and representing that and what we have seen. And indeed, Chinese stocks have rallied this year, but we have not necessarily seen that economic growth that has met that rally, despite some sort of fits and starts here. One of the optimists, though, on that front is Brendan Ahern, CraneShares CIO, who we spoke to earlier. He said the spending is indeed coming, and he talked about some of the signs he's looking at.
Yeah, I think what you're going to see is verbiage leading us to believe that the GDP target for 2025 will be around 5%, as well as that budget deficit expanded to 4%, as well as continued policy to supporting the housing market, the stock market, as well as potentially expanding some of the subsidies we've seen applied to auto and home appliances. That expanded as well.
You know, and he says it's going to take time to turn a tanker like the Chinese economy and to see sort of the spending work its way through the system. You know, he manages Chinese stocks in ETFs, and so he's watching that market very closely. So we'll see if indeed this time will be a bit different in terms of that stimulus, Josh.
We shall. Thank you, Julie. Now let's take a look at what's trending here in the after hours. Toll Brothers shares, they are under pressure after reporting fourth quarter results. Home builder posting better than expected numbers on both the top and bottom lines, but it was part of that forecast that's weighing on investors here. The luxury builder's gross margin guidance coming in shy of analyst expectations. We're also watching shares of Eli Lilly, the pharmaceutical giant, announcing a share buyback program to the tune of $15 billion. The company also announcing it's raising its dividend by 15% to $1.50, really raising its dividend for the 7th straight year. And Amazon bringing Intuit QuickBooks to millions of its third-party sellers through a new partnership. The deal will allow sellers to organize their expense, inventory, and tax data directly on the Amazon platform. Intuit QuickBooks will be available on Amazon Seller Central, the hub sellers use to manage their Amazon businesses. The company said sellers will see a real-time view of the financial health of their businesses. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.